Everyone's bullish, however. Let's go to Mike McGlone, senior macro strategist at Bloomberg News and a noted bear on crude oil prices. Mike, you've said to us in the past that the cure for higher prices in the world of commodity prices is higher prices. What do you make of these higher prices in crude oil?
Oh, the cure is going to work like it always has, Paul. Let's remember the high in crude oil was made in 2008. Last year's high was lower, and we've had 3 lows since, which are lower, lower, and lower. So right now we're bouncing into this upper end of the range. It could get to $100 a barrel, maybe in Brent, but you see what's happening already. It spikes CPI in the U.S., which keeps the Fed's finger on the tightening button. The ECB hiked rates. The Bank of England might hike rates this week. It's a lose-lose for crude oil. And I fully expect crude oil is going to do what it normally does. It spikes, and it's its own worst enemy, and it's going to head back towards that $40 a barrel, which is what it has done for the last few recessions when we're so overdue for a recession, which is already starting in Europe, yet they're still hiking. It's kicking potentially in China, they're cutting, and in the U.S. it's just a matter of time. You look at things like leading indicators. We've had this little bounce, but now we're all tilting over, and one of the most significant things might happen this week is when the U.S. stock market drops for a normal recession, which is way overdue for.
You've done some work recently on the property crisis in China and how it may affect commodities. Tell us about that.
Yes, well, it's just getting started. It's way overdue. We saw this happen in Japan. Right now we're seeing in China was similar to inklings to what happened when the Soviet Union peaked and when Japan peaked in 1989 or so. The Nikkei's never got above that level. And they also, with somewhat supporting this war, also really upset their best export customers, the US and Europe, which are both tilting towards recession. So China must be mentioned because they're the world's largest, most significant demand pull source for crude oil, and that's starting to tilt lower. The question is what stops it. In the past, it was the US. So I have to tilt back to what's happening in the rest of the world, notably US. If you look at the US and Canada, our excess of liquid fuel production over consumption is running around 6 million barrels a day now. 10 years ago, it was the opposite. That's been the number one pressure factor pressuring crude oil for the last 10 years, and they still continue. And what we're doing right now with prices pumping is pressuring demand, increasing supply, most notably North America, which is going to do what it always does for commodities. And you mentioned earlier, crude oil is not getting any endorsement from the other commodities, not from copper, not from corn, not from industrial metals, which means it's probably just a short-term bounce.
Okay, I want to bring back that graph on China, just have you explain it in a bit more detail to our viewers. The blue line is the China Producer Price Index year over year. That's a measure of wholesale inflation at the wholesale level. The white line, explain this to us, that's the China 2-year yield versus the U.S. generic 2-year yield. Is that what we're seeing there, Mike?
Exactly, Paul. And that's a train wreck just starting to happen. U.S. 2-year note yields are bumping up to the levels that were last seen in 2007, just above 5%, and they're getting squashed in China. So what does that do for the currency? It's the U.S. dollar strength. It's kind of hard to have anything. I mean, you can't short the dollar. It's most expensive to short currency on the planet. So that's just something that's, I think, a train wreck's happening. In the meantime, you see deflation in China. And that's what we can trust to the data. But overall, you can't really hide the rate differential in rates. And to me, that's just a matter of time that you see the second largest economy just have a little bit of reversion of its massive pump the last 10 years or so. And also, particularly in the back of the U.S. tilting towards recession because we're raising rates so much. But deflation in China, the lowest rate since the U.S. In 14 years or so, and it's kind of hard to see a strong currency for the yuan in that environment.
Separately, what do you see ahead for copper, which is, as we noted just a short time ago, has downshifted from the $4 level to the $3.80 level?
I think it's heading towards 3. That's where it was before COVID. It put in a pretty good high around 5. And the pressure factor for copper right now is negative. And the key question is what changes it? You need to see demand pull out of most China. It's not really happening. And the rest of the world, Europe and the US, tilting towards recession. Rates still going up. And it's really not profound for copper to go back to $3 a pound. That's where it was before. It's an enduring mean. The key thing to remember about copper is it has made new highs, higher highs, and higher lows for the last 10, 20 years. Crude oil is the opposite. So I'm looking for commodity people. If you're looking for bullish commodities, look for copper or gold. Definitely, typically not crude oil. Crude oil is its own worst enemy, typically.
Mike McGlone.